Bullish and bearish divergence. What do they mean? How can we trade them? What are the different types? Welcome back to another episode of TA with MK. My name is MK. In today's tutorial video, we're going to teach you about bullish and bearish divergence. And if that sounds interesting to you, please remember to like and subscribe, and let's go. It's TA with MK. It's TA with MK. Now, the first important thing to understand is what divergence is. And basically what it is in a nutshell, it's any time that the price action is doing one thing and one or more of the indicators that we use to trade, such as the RSI or stochastic or MACD, are doing something different. Typically when price is going up, you're going to see the indicators also going up. If price is going down, you're going to see the indicators match up with that in most cases, and they're going down. Anytime they're not doing the exact same thing, which we're going to discuss in this video, that is what is known as divergence. It's what the word means, is the two are diverging from each other, and that can sometimes be a clue as to the price action potentially getting ready to change directions. So now we're going to quickly talk about the three different types of bullish and bearish divergence. We have what's called Class A, or regular. We have Class B, or hidden. And we have Class C, or exaggerated. Now let's discuss. One important key thing to take note of before we move forward is just to know that bullish divergence is most commonly found in a downtrend, and bearish divergence is most commonly found in an uptrend. By nature, the idea behind these divergences is it's giving you clues or showing signs that the move is weakening in whatever direction it's going, and there's potential that it could be reversing directions. It doesn't mean it's always found that way. You can find bullish divergence in uptrends, and you can find bearish divergences in downtrends, but most commonly it's the reverse, right? Bullish in downtrends, bearish in uptrends. And now we'll do our best to quickly explain each of these three types of bearish and bullish divergence before we give actual examples with real price action on charts. So over here on the left, we've got Class A or regular, and we're going to do the example of this as a downtrend. So if you look over here on this bullish Class A regular divergence, it's showing a swing where its price actions went down, it's went up, it's put in a lower low here than the previous low, right? And now it's reversing potentially to go to the upside. So this would be known as a swing, right? Low, high, low. If you draw a line between there, or a trend line, you can see the price action was a low and a lower low. But down here on the RSI, following that same swing, this is representing the RSI, by the way, the Relative Strength Index, which is a video that I put out yesterday. Check the link in the description if you haven't watched that yet or you don't know what the RSI is, but it's one of the indicators that we use to trade with. It's just a momentum oscillator. But down here on this RSI, or what's representing the RSI, you can see that this put in a low, but a higher low. So the two diverge from each other. Typically, if price action's doing something like this, for example, you'd see the RSI doing the same thing, right? In this case, they diverge from each other, and this is what's known as Class A regular divergence. Now on the bearish side, it's just the reverse of this. It's happening in an uptrend where price actions put in a high, a higher low, and then a higher high, and it's starting to come down. So this high over here is higher than this high, right? So you draw a line across the top. And that's another thing to take note of as we go forward. Anytime you're spotting divergences, it's always going to be bullish A, B, or C if you're if the divergence is happening on the bottom of price action and the indicator, and it's always going to be, bearish A, B, or C, or regular, hidden, or exaggerated if you're drawing on the top. And it always has to match up as well. You don't draw one on the top and the other on the bottom. They're either both on the top, so a swing on the top of one swing to another swing on price action, and you'd match that up with the indicator, or the reverse for bullish would be the bottom. So you'll see that's the common theme as we go across these. So on the bearish here, you had a high and a higher high, but down here on the RSI, it put in a high and a lower high. So those are this is regular bearish divergence. And all both these mean is that this momentum oscillator down here is giving you a clue that the strength of the move is weakening. In this case, to the upside, you had this high and a higher high, which obviously would have people being bullish if they only looked at price action, because it would be going to the upside. But if you look down at the RSI, which is a momentum indicator, it's showing you that over the course of this swing to the higher high, that the actual momentum is, that it's losing momentum, which can be a clue often that price action could be seeing a retrace, in its near future. Of course, bullish divergence that we just went over would be the same thing. It just means that this move to the downside where it put in this low and a lower low. So obviously it's, in a downtrend, potentially it's like a falling wedge, for example. Well, if the RSI is showing a low but a higher low, it's just showing that the strength of that, the momentum to the downside for that move is actually weakening. Therefore, there's a good chance it could start to reverse to the upside. Also, super quick before we move on to the other two, I want you to know that Class A is the most commonly used in trading, and it has the highest percentage or probability of actually playing out. Obviously, divergence is just like everything else in trading. You use in confluence with other things, which we'll explain once we give examples on price action. But just know that this is the main one that you want to be focused on. I'm going to briefly explain the other two a little bit quicker than I explained Class A, but Class A is the most common one. And again, just remember that if it's bullish, you're looking at the bottom of price action, usually in a downtrend. And if there's a low but a lower low on price action, but a low and a higher low on RSI or other indicators, that's obviously bullish Class A divergence, and bearish is on the top of price action, typically in a uptrend where you have a high and a higher high, but the RSI did not match up. It put in a high and a lower high. Now, because these next two don't have that as high of a probability as playing out, and they're not used as often by disciplined traders, I'm going to go over them a little bit quicker and try to explain them best I can, but just a little bit faster. So Class B, hidden bullish or bearish divergence. Now again, for bullish, obviously you're drawing on the bottom of price action. This would be where price action has put in a low but a higher low, but the RSI has put in a low and a lower low. And you might wonder, why would that be bullish in any way? Well, one way to look at it is that the RSI, which was the momentum indicator in this case, it had momentum to the downside, but it didn't have enough apparently. It had more momentum during that swing to the downside to go down, but yet price action was able to hold up and put in a higher low. So that's just bullish, and it means there's a good chance that this may end up holding up as a higher low as the RSI inevitably starts to bounce and bring price action up with it. Flip side of that, you have bearish, hidden bearish divergence. That's where you've put in a high but a lower high during a swing, but the RSI has put in a high and a higher high. And so just the reverse logic there, it had more momentum to the upside, so in theory that should have brought the price action up higher than the previous high, but it was unable to do so. And so you would think that in the near future that the RSI is going to roll over and start to head this way, and obviously price action, that means, is going to confirm a lower high. And then you have Class C, or exaggerated bullish and bearish divergence, and this is just where price action on the bottom for bullish has put in the same level, so it's put in a low and then it bounces on the same level of support or same level of price action, but the RSI, which is the momentum indicator, actually started to gain momentum during that swing, which means the RSI may be starting an uptrend, which may drag the price action along with it. And Class C, exaggerated bearish divergence, is the opposite of that, where you have a high but the same high, so you could draw a straight line across the top of that swing or price action, but the RSI or the indicator has a high but a lower high. Okie dokie, now we're over here on a Bitcoin weekly chart, and I just wanted to give one more pro tip before we move on and give examples. Just know that divergences can be found on every time frame. The lower the time frame, the more insignificant the divergence is, and if it plays out, the quicker obviously it would play out. You're finding divergence on a small 5-minute time frame, you may see that begin to play out over the next few candles or the next 20-30 minutes, whereas something like a daily bullish or bearish divergence is going to be more significant, but also could take longer to play out, and the move's going to be slower, more drawn out, but more significant if and when it does play out. So just always keep in mind, time frame matters. If you're a scalp trader and you're just making super short-term trades and you're looking for divergence within maybe just a 6 hours worth of price action, just know that whatever divergence you're finding is going to play out quicker, and the move's going to be smaller. Whereas, like I just said, the reverse of that, larger time frames like daily or weekly, it may take some time for the divergence to play out, but it is more significant and has a bigger effect. All right, so the reason we started on the weekly time frame was just to get the most obvious and most recent divergence out of the way as it relates to Bitcoin and Bitcoin's price. So that would be the two all-time highs that we had last year, where Bitcoin in April had topped out at just under, I believe it was 64K, and then you had the following all-time high in mid-November-ish, early November, where it topped out at just under like 70K, right? So you had a swing high, a low, and a higher high. as far as from here to here. But if you do Alt-V on your keyboard to put a vertical line on both of those, we can go down here to the indicators. And you can see that down here, this was a high, but this was a little bit lower high. And this was basically confirmed once Bitcoin, it had broken its all-time high, which was obviously previous resistance, right? And it should have been able to flip that as support, break higher, flip it to support, and trend higher. Well, it ended up losing it immediately and then retesting it the other direction, and so it was a bearish retest. And obviously that became what was known as a bull trap. Just trapped everybody that thought, hey, Bitcoin's going to 100K, let's open up longs, and it went completely the other direction. But it also confirmed the bearish divergence because you had this high and a lower high at that point. And just before we move on from that one, I want to point out one other thing that was kind of a clue along the way that things were potentially weakening and that a reversal might be on the horizon. Or at least it should have suggested, hey, maybe it's a good time to take profits. And that's just showing back here that in December or early January of 2021, you had the RSI go all the way up to 95, which is extremely, extremely overbought conditions. And that was while Bitcoin was actually just barely at 40,000. And it was able to push up to one more high, clear up, like we discussed, just under 65. However, the RSI had already started to divert from price action at that point. You clearly had, in fact, this would be really the first divergence you'd want to look at if you spread this out a little better. You had divergences start happening all along here. You had a high, but a higher high here, high, lower high here. But because it's such a significant time frame, it doesn't always mean it's going to play out instantly. It wasn't that price action necessarily, that was the, high right there. It was able to kind of go sideways for a bit and even put in one last high. But clearly the percentage between this first big bearish divergence and how high it actually got was very minuscule, right? So it would have made complete sense to take profits and prepare for the idea that your indicator down here was starting to show signs of the momentum weakening. So basically our momentum began to shift down as soon as we hit 40K, but price action was still able to, well, it was confirmed once we actually hit around just under 60K, I should say, because that was officially a lower high on the RSI, even though we had a higher high on, price action. That was kind of your signs that the blood was potentially in the water and it was time to maybe get out of the market or at least scale back your positions. And it is also worth noting that there was some confluence as well with the histogram also showing a bearish divergence on the weekly. As I spoke about, we had this push up where basically the RSI topped out and then it was confirmed right here with this lower high, even though this was a higher high back in mid-February. Well, if you go down to the histogram, that was also the point it started to lose its momentum because you had this highest green bar here, which was solid green, which means that it, had strength in the move. And anytime these get lighter, it means they're losing strength, right? Whether it's losing green strength would be mean it's losing bullish strength. Whenever the histogram's red, the darker red means it has more strength to the downside, and once it starts turning pink, it just means it's losing that strength. Well, obviously you had this high right here, but then as price action swung to its new all-time high later that year in, mid-November, the histogram never was able to get up to those same levels of momentum because the histogram or the MACD is also a momentum indicator, and it just didn't have the same momentum. So that was also a clue that price action was getting ready to potentially reverse to the downside. And now we'll just quickly use the 4-hour time frame to show an example of a bullish divergence, regular bullish divergence. Now, for this, I'm going to use the price action between May 10th and basically May 12th. So just 2 days, right? And you had this swing low, then this swing high, and then a lower low, right? So just keep in mind that if you took a trend line and drew between this low and this low, obviously it's a low and a lower low. But once again, we can click Alt-V for vertical lines and go down here on our RSI. And you can see that it printed down here on the RSI a low, but a higher low. So that kind of shows that the momentum of this downside move was weakening, because obviously this is a momentum oscillator and it wasn't able to get down as low as the previous momentum to the downside. And so therefore it gave you the signal that there was a good chance price action was going to reverse to the upside, and it did for about a 16% move. Now, obviously, one thing to also keep in mind with divergences, again, to do with the time frames, it doesn't necessarily mean that the reversal is going to be to the moon or anything like that. it just may mean that there's going to be a short-term reversal, and it may sometimes only be 5 or 10% or 2% or 1.5%, right? You never know exactly what the reversal is going to be, but if you could use it in confluence with other things, like was this also an area of support at the time at around 27,000, 26,800-ish? We'd have to zoom out to look, but there's a good chance that probably was a level of support or near support as well, and so it just gave it a higher likelihood that that divergence would play out to the upside. Also, one thing to keep in mind is these divergences are much stronger the lower they are on the RSI for bullish ones, because obviously typically the lower you are, it means that the asset's very, very oversold and a reversal has potential of coming anyway. But then if you can start seeing divergence down there, it just ups the likelihood that it'll play out. And the flip side of that, you're going to find your strongest bearish divergences obviously up here where in these overbought conditions when you're 70 or higher. And again, just to understand the RSI, check the link in the description for the video that I made yesterday. If that's an indicator you're unfamiliar with, watch that video first, then come back and rewatch this video. And my final thoughts as we wrap up today's video on bullish and bearish divergence. It's just like everything else. Remember, this is to be used in confluence with other ideas, whether that be support and resistance. Is the bullish or bearish divergence happening near major support or resistance, or in major overbought or oversold conditions as far as the indicators or RSI goes? Is it happening inside of a pattern or above or below a major trend line? The more things you can find pointing the same direction, the better chance that whatever idea you have will play out, in your favor. And as always, if you guys are liking the content, please remember to like and subscribe. We'll catch you tomorrow. It's T